But I hope you enjoy this discussion. This is I call it this is kind of a partial discussion of a future symposium that we put together for 2019. I'm covering kind of an option piece, but if you like the general gist of this discussion today, and you like the direction I go, and this, by the way, I'm just going to warn you, this is not this is a pretty heavy discussion today. So how many people here have traded futures before? Cool, that's good. This is not a discussion on like what futures to buy or what futures to sell or anything like that. This is a discussion about using futures as a capital efficient instrument. And the reason that I had this discussion and the reason the CME asked me to speak for them was because the future of self-directed investing, and that's kind of what we all are, and I talked to a couple people in our booth earlier today, but the future of self-directed investing is going to be about capital efficiency. What that means is stocks are expensive. The average stock is over $100 now, which means 100 shares of a $100 stock is $10,000 in capital. If you want to trade some of the more liquid stocks and some of the more popular stocks where there's a huge concentration of money, like Apple, which is over 200, or Netflix, or Google, or even Microsoft's $135 now. Amazon is $1,800. $1,800 stock means that you have to put up $180,000 to trade 100 shares. So all of a sudden, the nature of stock trading has changed the dynamics for online investing. And I'm a customer just like you're a customer. We're all the same. And in fact, just in case you don't know me, I don't even do institutional events, and we don't manage any money. All we are is advocates and for the self-directed investor, and we build technology for the self-directed investor. So because capital efficiency is kind of what I believe is the future of self-directed investing, and the reason why I believe that is because in order to be successful, you have to put your money to use in multiple places. Instead of trading like making one big trade, like may have been the situation, or being 100% invested, which may have been the situation 10, 20, 30, 40 years ago, it's not like that anymore. It's kind of the concept, we promote this concept of trade small, trade often for multiple reasons. Diversification comes in many packages. Diversification comes by underlying, diversification comes by strategy, and diversification comes by duration. And in order to enable that, you have to be capital efficient. Most customer accounts, and this is not necessarily representative of anybody in the room, but just from doing this now on the customer side for over 20 years, the average customer account size is, let's call it $50,000. That's not assets, that's just customer trading account size, around $50,000. If you think about putting up $170,000 for 100 shares of Amazon, or you think about putting up, even $20,000, this is without margin, putting up $20,000 for 100 shares of Apple, it ties up a significant portion of a $50,000 account. If you're tying up 100 shares using $20,000, that's 40% of your account. If you borrow, so you only use 10, which is the maximum borrowing allowed, you're putting up 10,000, you're borrowing 10,000, and you're borrowing at a very inefficient rate. I am not a futures trader, but I'm a trader. So what that means is I believe that customers should be product indifferent in 2019. In 2000 or 1990, people say I'm a stock trader, or they'd say I'm an option trader. I would spend my whole career from 1980 to 2000 saying I was an option trader. Today, I am not an option trader. I'm not a futures trader. I'm not a stock trader. I trade any product. I couldn't care less what it is. Whatever's the most capital efficient approach that gives me the most non-correlated diversification, that's the most interesting thing for me to do. So that's what makes this conversation different, because I don't think that anybody will cover this same topic or the same use of futures that I'm about to talk about. The breakdown of our customers, and we have at Tastyworks right now, which is the first company I built was a company called Thinkorswim, which was bought out by TD Ameritrade in 2009 because we were a public company. The second company I built is called Tastyworks. And Tastyworks is a very aggressive piece of technology that is very fast and supports all products. But the funny thing is, when I built Thinkorswim in 1999, 2000, originally we thought that maybe 50% of our business would be derivatives. In the end, it turned out to be about 70% of our business was derivatives and 30% was stock. Today, in 2019, because stock prices are so high, and stock purchases are so inefficient, 97% of our business is derivatives. 97% is options, futures, and options on futures. 3% is stocks. And we have 100% customer base. You know, over 100,000 customers, 100% of that, or I'm sorry, 97% of that is not trading stocks. What's so interesting about that is the message that we've been preaching and the message that we've been promoting about capital efficiency and about being product agnostic is actually taking hold, and it's really benefiting individual investors. Now, it benefits you a couple different ways. It benefits you from the natural diversification. It benefits you from the capital efficiency side. It benefits you strategically, and it also benefits you, obviously, you know, product-wise, and again, the non-correlation. Recently in the market, you've seen markets have been much more volatile the last couple of weeks. And in the midst of that volatility, the one thing that really stood out to me was in that down move, and the big down moves we had, almost all stocks go to a correlation of 1, which means that it doesn't matter what you have on. When the market goes down, stocks go down. If you looked at commodities, they did completely opposite. Gold went up, bonds went up, currencies, you know, the dollar went higher, some of the other currencies went lower. Basically, every single commodity just has a mind of its own. Now, what's good about that is when volatility gets higher, there's a lot more opportunity in non-correlated underlyings, so you don't feel like everything you're doing, you're at the risk of the stock market going lower and things like that. So today's conversation is a discussion on which most people don't cover, which is options on futures. Now, the interesting thing here is at Tastyworks, and we can only talk about our own brokerage firm, although the whole industry is following the same pattern that we've established. At Tastyworks, we trade more options on futures than we trade futures. And when I say we, I'm talking about our customers. So options on futures now have become more popular than, you know, more popular with our customers than the futures themselves, which again makes this interesting because years ago, you could barely get a decent market on a futures option. Today, they trade just as liquid as almost just as liquid as the underlying future. Every single product that I'm going to show you today trades 1 tick around theoretical mid-price. That means if you put a spread in or you put an order in to do a certain option strategy in the futures options that I'm going to show you today, every single one, when it defaults, our platform defaults to the mid-price. Most platforms default to the mid-price. If you move 1 tick higher, you can buy it. If you move 1 tick lower, you can sell it. That's what we call liquidity. That's what we call product efficiency. That means you can basically do anything you want to do 1 tick around mid-price. So that's kind of the basis for this discussion. You're going to see a lot of advances in futures over the next couple of years. Some things I can't talk about because we're being sponsored today by a different exchange. But what's interesting is over the next couple of years, you're going to see a lot more capital efficiency driven by futures options, because it's really going to be a huge replacement for stocks. One of the problems the stock market has, and I love the stock market, don't get me wrong, because I live in the options world, 75 to 80% of all the trades I make are option trades, but about 20% are futures trades. And what you're seeing start to happen right now is you're going to see just people start to embrace products that just allow them to use a different margining system. Futures work off what they call span margining, and it's a different regulatory body than stocks and options. So the stocks and option marketplace uses a system, a legacy system of margining from a long time ago. That's why you have to put up 50% for stocks. Options don't have margin, you just have to put up cash for it. On futures world, it's a little bit different. It's span margining, so it's much more leveraged. So you have to be a little bit more careful because the products are bigger and the leverage is greater. But as soon as you work through some of the complexities of non-standardized products and the additional leverage, you'll start to see some of the advantages. What I'm going to show you today are the advantages of just kind of dipping your toe and getting your feet wet with respect to futures options as a really nice kind of portfolio enhancement. It will change the way you think of, you know, a lot of times we found in this industry that only 10% of the retail customers are approved for futures. 10%. That's a crazy number. At Tastyworks, we try to approve 100% of our customers for futures trading, just so they can be fully diversified. And in the industry, you're going to see over the next couple of years that firms will make futures, more approachable. There's big firms out there like that there's firms out there with 5, 10, 15 million customers that don't even offer futures. Doesn't make any sense to me. Because in today's world, you have to offer all products, basically, to be the complete firm. So, last thing I'll mention is, with us, if you have a futures account with Tastyworks, one of the things that's a little bit different from firms if you don't have it is we allow futures trading in an IRA as well as a regular margin account, and we allow options on futures in an IRA as well as a regular margin account, and we allow any kind of spread and any kind of naked position in an IRA as well as a margin account. So we don't distinguish, and you don't have to have a certain amount of money in your account to trade them. So we've eliminated all the barriers to entry. All these old barriers like $25,000 or all these old barriers like, you can only buy something or you can't trade options. We got rid of all that stuff. So everything we talk about today, you can do with us in a regular margin account or in an IRA account, just so we're clear so you can put everything out there. So it's applicable for anybody. So, and what's cool about this is this discussion, hopefully there's a bunch of different takeaways in here. And I'm hoping when you'll try out some different strategies and you do it really small. When you're trading futures, the one thing to remember is, I'm going to show you all liquid products. So the one thing to remember is, whatever you think your size is, cut it in half. Whatever you think is a not too big a trade, cut it in half and make it smaller. Because these products are bigger than stocks. Like for example, a one-lot trade in the bonds is the equivalent of 10 options in TLT. And a one-lot trade in gold is the equivalent of 10 gold contracts if you're trading GLD. So you just have to be careful, and I'm going to show you some of these equivalencies today so you understand the difference in size. Once you get through the difference in size, the concept of being product agnostic is going to be, I believe it's going to be really, really helpful for you. So enjoy. And the only other thing I'll mention is, if you like this approach to kind of, I don't call this education as much as I call this kind of evolving content, but we are doing an options symposium in San Francisco on December 7th. That's the next time I'll be out here. It is a Tasty Trade sponsored event, and I don't remember the exact location, but you can go to the events piece of our website, and it's free. It's a 2-hour seminar live in San Francisco on a Saturday morning, December 7th, and it'll be Tony Batista and myself giving it. And it's along these similar patterns, but instead of doing it futures-wise, it'll be an option symposium. So if you want to come out, if you like this format, please sign up for it. Event will be filled. So here are the 7 underlyings that we're going to talk about. Now, there's a lot more futures products. We offer 23 on our platform, but I'm only going to show you 7 today. And the reason for these 7 is it's strictly a liquidity reason. I just want you to be in the most liquid underlyings. And by the way, I can't give you this presentation because I'm doing a similar presentation in New York City next weekend, and I have 1 or 2 left. But if you email me in another month or so, after I get through New York and one other presentation, I'll be happy to send you the presentation. I just don't want it out there until I finish up this current tour. So, but in another month, I'll be happy to send you a presentation. We'll send you any presentation we do, and if you want to just kind of go over it. Those are the 7 most liquid underlyings. These are the 7 that we trade most actively. These are the 7 that are most active on our platform. And another thing to note about futures is, unlike stocks, they trade from Sunday night at 5 o'clock until Friday night at 4 o'clock. So approximately. Some have kind of weird hours, but generally all these futures start trading at Sunday night at 5 o'clock and they go through the following. So we call it like 24/5. So ES, the S&P 500, 6E is the euro, CL is crude oil, GC is gold, NG is natural gas, ZB are bonds, and ZS are soybeans. Now, I mix these up. Like, of course, you could trade 10-year notes. They're the most liquid of all the debt instruments. Corn's been really active lately if you want to switch out corn or wheat for soybeans. And of course, if you want to switch out the euro for the Japanese yen or the British pound, it's all the same concept. They're all liquid. But I picked these 7 for the purposes. These are 7 with the deepest 1 tick wide option markets. So for the purpose of this discussion today, too, I'm going to make one other assumption. I'm going to assume that IVR, which stands for implied volatility rank, is high. Now, the reason I say this is because if you're a tasty trader and you watch our shows, or you kind of know the direction we work from, we like high implied volatility, which represents in our mind a high level of fear, which also represents then or equates to a high level of opportunity. So we consider high IVR a necessity to have in order to make trades in some of these underlyings. But for the purposes of doing a seminar on a specific day, I'm just going to assume that they all have high implied volatility rank. What is implied volatility rank? It's implied volatility measured against itself for the last year. So let's say I walked up to you and I said, the implied volatility of bonds is 13%. There's about 1 out of every 100 or 1 out of every 1,000 people that trade actively would know if 13% in the bonds is high or low. I'll ask you, is 13% high or low? What? Low, right? Low, right? Very low. See, I got low, low, very low. It's extremely high. And I'm not just saying it, it really is extremely high. Bond volatility is usually around 9 or 10%. So 12, 13, 14% is 50% higher than it usually is. But you wouldn't know that, and I wouldn't expect you to. And nobody would know that. But if the implied volatility rank, which is what we show on the platform, said it's at 80%, then you would know on a scale of 1 to 100, it's at 80%. So the assumption here is that implied volatility rank is high for all these discussions, because that's why we put some of these positions on. So we're going to talk about strangles, credit spreads, ratio spreads, and wide iron condors with a bunch of multiple strategies in a bunch of non-correlated underlyings. And as I'll show you later at the very end, there's a huge payout. There's a giant reward on the end, on the conclusion of this, which will show you the correlation of all these underlyings. So let's just say, and this is how I'm going to present this, and you can take pictures of it too, whatever. Let's say I'm building a portfolio, and I understand a lot of you have positions on. You might have a long bias retirement account. You may have a long portfolio. You may have stocks you like, stocks you don't like. You may be long some stuff, short some stuff, whatever. After the last couple of weeks, you realize the volatility of your portfolio. What if you diversified a little bit? And what if you started to put on some option positions, some futures options positions that have, in some cases, I'll show you stuff with defined risk. In some cases, I'll show you stuff with undefined risk. A strangle is the simultaneous sale of a put, out-of-the-money put, and an out-of-the-money call, which has undefined risk. This is not for everybody, but in the world of futures, the capital requirement is a fraction of what it is in the world of stocks. And in this case, this is a very low implied volatility. The euro doesn't move that much. It's a currency. No currency moves that much. And in this case, we're going to sell one, just one. And now, it's interesting because the discussion that I'm giving you today, I should have given you a little context. The discussion I'm giving you today is for a $25,000 account. So I said the average account size is 50. This discussion today is applicable to a $25,000 account. So I didn't go some crazy number like 100,000 or a million or anything else. It's a $25,000 account, and you're not even going to use anywhere close to $25,000, but I'm not going to tell you what the exact number is yet. I'm going to look at about 7 underlyings, 7 trades in a $25,000 account, and we're going to show you a diversified portfolio that has a minimal amount of risk, a low standard deviation of risk, an interesting return on capital potential, and all non-correlated. And if you make it through the next half hour of all that discussion, your takeaways are going to stick with you, and you'll be able to articulate it for a long time. So I'm going to sell one 25 delta strangle. That means selling out of the money put and out of the money call. I'm going to collect in this case, and these are real prices as of yesterday. So I updated all these prices yesterday. I'm going to collect $1,100, and the buying power reduction is $1,200. That means how much money you have to put up. Just in case you don't know this, if you borrow money to trade stocks, you pay margin. If you cannot borrow money to trade options, and you cannot borrow money to trade futures. So the amount of leverage, because somehow you have to pay for leverage, right? When you do something that's highly leveraged, you have to pay for it. Nobody's going to give you the leverage. So what they do is they build in, the borrowing costs are built into the price of the underlyings. So the borrowing cost is built in there at a carry rate of 2%. So instead of paying 7% in margin like you do for stocks, you pay 2% built into the price because everybody pays the same price. So professionals and retail customers. So you collect $1,100 and you put up $1,200. Now, what I did here is, just so this becomes clear, because this is kind of a really complex discussion. I promise you, nobody will have this discussion at any show you ever go to. I've just loved doing this because it's challenging. If you do that one strangle in the 6E, which is the euro, the corresponding ETF is FXE, which trades, and it trades pretty actively, a couple million shares a day. FXE, you'd have to sell 16 strangles with 35 days to go to expiration, with 25 deltas each, which at this time would be the 105, 108, and to collect the same $1,100. But the difference here is you have to put up 32,000. So the whole concept of capital efficiency, you see it on this first slide. You do the futures trade. These are the exact same trade. I should point this out. Everything I'm going to discuss today is the physical or the cash market or the futures market versus the equity marketplace. They are the exact same positions. If you trade an S&P 500 E-mini and you trade spiders, they're exactly the same. If you trade SPX and ES, they're exactly the same. If you trade gold and GLD, they're exactly the same. If you trade, in this case, FXE versus 6E, they're exactly the same. It's just quantity differences. So in this case, for collecting the exact same amount of credit, you're putting up 32,000 versus 1,200. So I'll take this to the next level. We'll go to crude oil. In crude oil, in this case here, instead of undefined risk, I'm going to sell a 35 delta credit spread. I'm sorry, I'm going to sell a 35 days to expiration, 30 days to expiration, the 35 delta calls, the short call. We're going to sell a credit spread, the 57, 58. I think crude oil was about unchanged today, so it's probably around 55, 54, 55. The credit we're going to receive for doing this, and you'll notice we're receiving credits for everything because I like to collect credits, is $300. That means the risk in this trade is $700. If you were trading an equity product, you'd have to put up $700. In this case, you only have to put up $300 because it's a different margining system. What's fascinating about this, and this is a defined risk trade, is here you can see that the buying power reduction, if you were doing it in the ETF equivalent, in this case, USO, you'd have to trade 27 spreads. Your commissions, your transaction fees would be higher. You'd have to put up $1,000 instead of $300, and the credit received in this case would be the exact same. And you get in the picture. This is all a discussion about capital efficiency. And if you come to one of our future symposiums, I get into this stuff in a lot more detail, and which means your head will be spinning when you get out of there, but you'll understand futures at a whole different level. This is the S&P, ES, /ES. And so in the ES world, I'm going to do an iron condor. This is defined risk. 45 days to expiration, sell the 16 delta option, buy the 10 delta option. These are actual prices as of yesterday. I know we had a big rally today, but as of yesterday, you're going to collect $600, you're going to put up $1,200 to make this trade one time in the futures market. Now, the weird thing about futures, and the thing that's not good about them, is that a dollar in the ES is different from a dollar in the euro, and that gets confusing to people. And that's just the one hurdle you have to overcome. But what's not confusing is that if I did the exact same trade using, in this case, using SPY, which most people trade, including myself, and I did 5 of the SPY trades, which is equivalent to 1 of the ES trades, and I'm collecting virtually the same credit, instead of putting up $1,100, I'm putting up $3,300. Now remember, we're talking about a $25,000 account, and I'm putting on all these positions using a fraction of the capital, and they're the exact same positions. SPY and ES are exactly the same. Yet, only 10% of the retail investors in America, consumers, are approved for futures, which makes absolutely no sense. It's like going into a casino and saying you're approved to play slots, but you can't play anything else. It doesn't make any sense. But in this case, the numbers are really interesting here. And this is the most powerful discussion for futures. You know, futures used to be a leveraged instrument for speculation only. And that's why 95 to 97% of the people who traded futures lost money, and that's why it was a dumb product. Not dumb in the sense that it was dumb for retail investors. Because between the bid-ask differential, the high exchange fees, and the fact that it was strictly directional didn't make any sense to me as a pure and white. It's just a speculative black and white instrument. This makes it strategic. This discussion today makes futures strategic. And if we can make strategy, if we can combine strategy with capital efficiency, every single self-directed investor is going to be far better off. So this is a really interesting discussion because you put up 1/3 of the capital to collect the same credit. In this case here, this is gold. So in gold, I'm going to sell a call credit spread here in gold because gold's had a huge rally. I'm going to collect $200. I'm going to put up $200. I'm going to collect $200. I'm going to put up $200. That seems like a very fair, that's a really nice potential return on capital. If I did the same thing using GLD, and trust me, my GLD positions are huge right now compared to my gold GC positions. So I mix and match and I use both. But because in my mind, sometimes GLD is more efficient. Efficient in the sense that it's more liquid. But you'd have to sell 10 GLD spreads to collect the same $200, but you have to put up $800 to do it. So it's 4 times as much capital for exactly the same position. GLD is a physical, and GC is the physical. That's it. They're both physical gold. They both have the equivalency is exactly the same. And in this case, you put up 4 times the amount of capital. So what's the risk? Why wouldn't everybody do the futures? Well, the difference is not everybody wants to do a 10 lot of GLD. Some people want to do a 1 lot of GLD. So it's a size, there's a size constraint, there's a size limitation. That's the one thing. The size may make certain people uncomfortable because they're big products. So here in this example, this is natural gas. Now natural gas is another big product. So why wouldn't everybody use the natural gas futures? Well, because sometimes it scares you. But in this case, I'm going to do a ratio spread, which means I'm going to buy 1 put and sell 2 puts because natural gas is on its butt. It's all the way down to $2. I don't know how closely people follow natural gas here, but I mean, you read a lot of stuff about Berkeley saying basically no more natural gas, so it's probably in, at least it's on the front page of the newspapers here discussing, use of natural gas, and it's on its butt right now. Natural gas around $2. The lowest I've seen it in my lifetime is just over $1, and the highest we've seen it is probably $12. So it's obviously near, it's on the low side. But to do 1 ratio spread, which is a undefined risk trade, to collect $650 in credit, I have to put up $1,400. And that's to trade a undefined risk position in natural gas. But if I used UNG, which is the equivalent ETF, I could do it 4 times, and I have to put up $1,600, and I collect about the same amount of money. But it's a whole different, the ratio is a little bit different. It'd be 4 by 8, so the transaction costs are a little bit more. This is the closest thing you're even going to see, these two. I put it up there because occasionally there'll be situations where you're like, hey, you know what? This isn't that much better for me. This isn't that much better, so maybe I'll just use UNG and stay smaller. So you can test the stuff and you can see. But in this case, you still save. You collect more credit using NG, and you put up less money. And you know what? So how does the math work in that sense? Well, the math is real simple. If you're doing trades like this ratio spread, and I'll give you, this is just a quick math lesson. This ratio spread has a probability of profit of about 80%. It has a low, and when I say that, I mean the probability of making 1 penny is over 80%. That's just the nature of ratio spreads. So you have this incredibly high probability of profit, or at least making 1 penny. So in this case, it's 80%. So then why is it so important about capital efficiency? And the answer is because you want to stay as small as you can and put on as many positions, because one-off time doesn't mean anything. But if you do it enough times, then the kind of law of large numbers kicks in, and then what's supposed to happen, happens. Nothing in investing, nothing about strategic investing is about doing something 1 time. Because 1 time anything can happen, 10 times anything can happen, 100 times anything can happen. But 5,000 times or 1,000 times or 500 times, what's supposed to happen, happens. And so if you're supposed to have an 80% chance of success, in order to realize that over a long period of time, you need enough occurrences. In order to create enough occurrences, you have to have the most efficient use of your capital. To have the most efficient use of your capital, you've got to be able to use all products. And I'll show you some other things in another sec. These are bonds. In this case, I'm going to sell a 30 delta strangle in bonds. 30 days, DT is days to expiration. 30 days out, 30 delta strangle. And in this case, the 159, 165 bonds have been on a tear as of late. To collect 1,800, I have to put up 1,800. It's a very nice potential return on capital. There's obviously a lot of risk involved there, but in this case, I just want to show you the numbers. If I did the same thing in TLT, I have to put up $17,500 for the exact same position, exactly the same. There is no difference. They are the same underlying. And when I say the same, I'm talking about like a 98% correlation. So in this case, you'd have to do 7 of the strangles, the 30 delta strangles in TLT, and you'd collect $1,700 to get the credits about the same, but you'd have to put up $17,500. That's a huge difference, and it changes the way, it changes the number of trades you can make, and it changes your potential outcome because you're limited by the number of occurrences you can ultimately have. And the less occurrences, the less chance you have getting close to the number. Just think of it like if you threw up a bucket of coins and you threw up 10 coins, and you would expect it to be half heads and half tails. But with 10 coins, you could easily come out with 70-30 or 80-20 one way or the other. But if you threw up 1,000 coins or 10,000 coins or 100,000 coins, you're going to come out, the more coins you throw up, the closer you're going to come out to 50-50. It's the same thing with trading. Markets are too efficient now. They're random and they're efficient. Randomness in price, efficiency in pricing. So this would be, I think, the 7th trade. This is soybeans. In this case, I'm just going to sell a naked put in the soybeans because soybeans have been on their butt lately. I think they were up today, but they were on their butt before today. So sell one naked out of the money put. You collect $400, you put up $1,400 to sell one naked put. If you were to do the same thing in an illiquid ETF, which is SOYB, that's the soybean ETF, it's the closest thing we have, which is physical for physical, you'd have to sell 16 of them, you'd have to put up $11,000 to collect the same $400. You get the message. You see what I'm trying to accomplish here. I'm trying to point out the huge difference from the way regulatory bodies look at different products and the amount of capital they require every customer to put up. It's no difference. Nobody gets a break. Everybody puts up the same amount of money no matter what. That's just the risk-wise. Why is that the case? That's the case because people that own brokerage firms like us, we make like $1 for you making the trade. You trade one contract, we make $1. And for $1, we're not going to take an unlimited amount of risk, so it has to be something fair, so we use the minimum requirements from the regulators. So what happens is, I take you to this slide here because this is a recap of what we just did. On the first column, you see the credit received. Every position I put on is a position that is defined by receiving credit because I'm a premium seller, and we like to sell premium in periods of high implied volatility rank, when implied volatility measured against itself is high. And in this current environment right now, implied volatility until today came in about 10%. It came in probably over 10% today, volatility did. But until today, volatility has been heightened in the last couple of weeks. In that heightened volatility, you've seen a 25 to 30% rise in implied volatility. That means there's 25 or 30% more opportunity in pricing. It doesn't mean it improves your probability of profit. What it does mean is it improves the amount of credit you receive, so potentially if you're right, you make more money. But you're still right the same amount of time as you would be with low volatility. What's interesting here is I highlighted all the spreads that you did. They're all different. Diversification comes in many different packages, comes in many different colors. It comes strategically, it comes product-wise, it comes correlation-wise. In this case, you can see this is strategic diversification. The credit received is because everything we do is about receiving credit. The next column is the buying power reduction, so you can see what that is. You're not borrowing any money to do this. You have a $25,000 account, that's all the money used in that middle column. The delta, so one of the cool things we do is we beta weight all your positions. That means we take apples and oranges and peaches and bananas and pears and everything else, and we make them into a single fruit, like a banana. That's what beta weighting is. You take all these different fruits and you make them all equal based on 5 years of history, a single fruit. That's what that SPY weighted delta is. So your entire position is weighted to the S&P 500. In this case, you can see the S&P weightings at the bottom. The theta number, the next column over, is the amount of daily decay that we're creating off these positions. How much money do they make every day if the underlying doesn't beat us? Now, a lot of times the underlying will beat you, but in this case, the assumption is for theoretical purposes, that's the amount of money you collect every single day. And then the last column is that money totaled out, which gives you an extrinsic number. Make sense? Perfect. So I just put the totals on the bottom so you can see this. The first column, the credit received, I received $5,000 in credit. Now remember, I'm only using a $25,000 account. I received $5,000 in credit. The next column over is the buying power reduction. $7,400 I used. So of a $25,000 account, I used less than, let's just say less than 30%. Of a $25,000 account, I used less than 30% to create $5,000 in potential profits, but I'm going to talk about that in a second, what's realistic expectation. The amount of SPY delta, that's directional risk as it equates to the S&P 500 using $7,000 is 0. It's -1, so it's 0. That's a statistically insignificant number. There's no statistical significance to -1. So you end up collecting $5,000 using $7,400 in capital with statistical directional significance of 0 beta weighted. The amount of daily decay is $71. That's a lot for only using $7,000. That's your 1% number, which is really high. And then the amount of extrinsic, again, is going to be the same as the credit received in this case of $5,000. So these positions have a beta-weighted correlation of 0.2. Now, a 0 correlation would mean that they have, they don't even move, none of them move in relationship to each other. A 0.2 is about the lowest correlation you're ever going to have for a portfolio. It's almost impossible to go to 0. +1 means they all move together. -1 means they move inverse of each other. And 0 means that you have a true diversified portfolio. So I showed you 7 underlyings, and they have a portfolio correlation of 0.2. That means, as it says up there, these positions are largely independent of one another, which means if bonds go up, it doesn't have anything to do with gold. If gold goes down, it doesn't have anything to do with the euro. That is very interesting to have because that means, unlike stocks, you don't win with everything or lose with everything. They're all mixed. In this case here, you can see the amount of money required along with the credit received. So we just gave you a little example here so you can see the buying power and then the credit received because you couldn't create this model using stock or stock options. Now, is this going to change the way I trade? Not at all. It may change the way you trade, but for me, about 20% of my positions are always going to be options and options on, 20% of my positions are going to be futures and options on futures. Maybe at some day it'll be 25 or 30%. The majority will be because of the wide range of potential underlyings in the equity marketplace and the index marketplace will still be index and equity options. But for 20 or 25% to replace what normally is, for most people, stock usage, that's different. So what you see here, again, is a very cool picture of how much credit you actually receive. Then I broke it down so you can see a pie chart. And that's the way we used our buying power. 16% for the euro, 4% for crude oil, 3% for gold, 15% for S&P 500, 19% for natural gas, 24% for bonds, and 19% for soybeans. And any one of those is replaceable with anything else. Now remember, there's a $25,000 account using $7,000 total. Generating 1%, generating $5,000 in theta or almost $70 a day. Now, oops, I didn't want to get there yet. Now, what's interesting, because I've got to talk to you about this for 1 second, that's important. There's a takeaway. I think they forgot my last slide, so I want to go back to this. Here's the really crazy important takeaway from this. The amount of money you can expect to keep from this would be the first thing that I would want to know. Like if I was listening to this discussion for the first time, and you say, okay, all this kind of makes sense. I get the strategic diversification, I get the product diversification, I get the capital efficiency. But what is a reasonable expectation? What's a reasonable expectation? Now remember, this is these are between 30 and 45 days. So there's somewhere between, let's call it 8 and 10 of these cycles in an annual basis. Okay, between 8 and 10. It just depends because we had to use, based on whatever's out there, we had to pick the current month. So there's between 8 and 10 of these potential cycles. Now, if you are not a tasty trader and you've never heard me talk about this before, I'm going to throw this question out there. What percent is a reasonable percent to think that you can keep of that $5,000 that you've collected in credits. And I'd like a non-tasty trader to fire off what they think is a reasonable number. What was that? 16% you said? 60%. Okay, that's one person. That's a good answer. 70%? 60, 50, 70. 10. All right, we're enough of that guy. We go here all night. No, this is the interesting thing. The dollar per risk is the same regardless of whatever you sell. So that's how efficient and that's how symmetrical pricing is in derivative marketplace. It doesn't matter how far out you sell. You can sell at the money straddles, you can sell out of the money strangles. It makes no difference. The dollar per risk is the exact same, and it's priced perfectly efficient. The answer to this question is the expectation is that you keep 25%. That is the target. And I'll go through the math in a second. But the expectation is you keep 25%. And the reason for that is it's unrealistic to think you can keep 100%. I mean, there may be one time in 20 years that you keep 100%. For the most part, you keep about 25%. That means you make adjustments, you manage early, you do all this kind of stuff. But if you keep about 25%, now let's just think about this for a second. If you were to keep 25% of that 5,000 number, you'd be collecting just from this portion of your portfolio, you'd be collecting about $1,250, around $1,200, yeah, let's say $1,250, exactly right. You'd be collecting about $1,250 for that one cycle that goes either 8 times a year or 10 times a year. I'll reduce it to 8 just to make it the worst case. So you collect $1,250, you do it 8 times a year because that's a 45-day cycle that goes into 350 because you count weekends and everything else. So that means if you multiply 8 times 1,250, it comes up with 10,000. Your return on capital for this little exhibit today, this little discussion today, in a perfect world, because the world's not perfect, and it doesn't always work out like this, but your return on capital for using that $7,000, you put up $7,000, you're making $10,000 at the end of the year, your return on capital is over 100%. In this case, it's 120, 125, 130%, but that's a perfect world. And that's only keeping 25% of that data number. That's what high return on capital will do, because if you remember the SEC side, the stock and option side, the security side, requires on average 4 to 5 times more capital than the future side. So you have to basically divide that number if you were to do it using the same strategies and same approach to the SEC side, and your target return on capital for the exact same amount of risk is somewhere between around 30%. I'm just going to ballpark it, but it's around 30%. So your return on capital goes from expectations of 100 to 125 or 130% down to expectations of between 25 and 30% just based on capital usage. There's no change to the risk metrics except that this forces you to have a little bit bigger positions than you might be comfortable with. But it only uses $7,000. That's the whole beauty of this discussion, is that basically you're generating enough potential return on capital to skew the entire portfolio with non-correlated underlyings. These are non-correlated, diversified underlyings, better than you can have with any stocks. Like if you trade Amazon, for example, and you trade it against Facebook, the Amazon-Facebook relationship to the S&Ps, it's almost identical. If you trade Amazon and you trade it, or let's do this, you trade Apple, and you trade Apple, and I'll use a non-NASDAQ stock, versus Exxon. So you say Exxon versus Apple. Okay, those should be completely not correlated, but they still have about a 60 to 65% correlation over time. These have a 0.2 correlation. So you're not at risk for all of these things moving together. So you have non-correlated, strategically diversified positions with the potential return on a small percentage of your capital, less than 30% of your capital, to exceed a number that you can't get to based on capital usage in a securities account. See, to me, that's a really interesting discussion. Hold on one sec. Checking my time, making sure. Because otherwise, you know me, I never take any questions until we're all done, because you may be the only person that wants to hear what you have to say. Hey, no, I'm just kidding, but the first thing we teach speakers is, if you want to speak for us, Don't take any questions, but when it's over, you stay there until the last person gets their last question answered, because that's important to us. It is exactly 2:30. I took up my whole 45 minutes. I gave you like an abbreviated version of our Futures Symposium. If you like this discussion, we do it via options coming up in December 7th in San Francisco. It's our next trip here. We do the long version of this Futures Symposium. If you really get into trading futures, we'll be in Los Angeles. I believe it's November 17th doing these shows. These are tasty trade shows only. You do not have to be a customer. You can come to it if you sign up. We let anybody come, but you have to sign up on our website because they all get filled up. But if you'd like to come to them, you know, it's important. We do 27 live events a year, and they're all free, and they're all really, they're generally pretty heavy. We do a couple of light ones, but most of them are pretty heavy. If you like this kind of aggressive content, nobody else, I don't believe anybody else talks about this stuff. So hopefully, I'll go to end. Hopefully that made a lot of sense. And now I'll hang around and you can ask any question. We got a couple seconds here, so if you want to ask a question. Anyway, thank you all for staying. I appreciate it. That was a good discussion. Go ahead.